So I'm glad we get to have this conversation about life insurance. Maybe you can start by telling me or by sharing what's going through your mind or why you're interested in getting a life insurance cover.
Anything to have security for the future and just to have a plan in case of any eventuality or anything.
Okay.
Yeah.
All right. So do you have an understanding of how life insurance works, or should I go ahead and first explain so that you also have an opportunity to ask me questions?
I think you can go ahead and explain because I've had so many versions, and it will be good to hear what your company is offering and just to understand it from your point.
Okay.
And I can ask questions.
Okay. All right. That's perfect. Okay, so the main reason why we buy a whole life insurance cover, it is to protect our beneficiaries. So, and our beneficiaries can be our children, our spouse, parents, nephews and nieces, siblings, literally anyone who depends on your income for survival. Because the question is, if you passed on prematurely, what would happen to the people that depend on your income for survival? So in the case of when somebody is a parent, so think of a parent, let's say, who has a 3-year-old child. If this parent passed on prematurely, they would leave that child stranded because they haven't left that child money for school fees, clothing, toys, and everything else that a child needs in order to develop into a functional adult. There is a situation we see in Kenya, in a Kenyan society where when one parent who is the main provider passes on, or two parents pass on and they leave children, those kids are usually tossed from one home to another. One time they're living with an auntie, another time with an uncle, sometimes with a grandparent, and eventually those kids might actually end up in a children's home. I've also seen another situation where if a parent has 3 kids and then they pass on, because one relative cannot afford to take up the 3 kids, so those siblings are separated and they are brought up in different homes. And obviously that's not good for the kids, because you want to grow up with your sibling and you grow apart over time because you are brought up in different homes. So ideally you buy a whole life insurance cover so that if God forbid you passed on prematurely, you leave your beneficiaries X amount of millions so that their lives can continue uninterrupted, at least financially. So the way it works is that you buy a cover. Let's say you're paying 15,000 shillings per month and you're going to be paying for that cover for the next 15 years. And let's say the insurer tells you that if you passed on prematurely, we are going to pay your beneficiaries 10 million. I'm using 10 million here just as an example. We're going to do the math for your cover, right? So you're paying 15,000 shillings. You're going to be paying for the next 15 years. And if you passed on prematurely, they'll pay your kids 10 million. Or sorry, not your kids, your beneficiaries, because as I said, there's a wide range of beneficiaries. Yeah, so then that means if you passed on a year from now, 2 years from now, 6 months from now, 7 years from now, if you pass on within the 15-year time period, yes, your beneficiaries are going to be given that 10 million as a lump sum so that they use it to continue with their life. So usually the question I get asked a lot by people, and it's a frequently asked question, is what happens if I do not pass on within the 15 years, which is a very important question because all of us want to live a long life, right? You want to live as long as possible, especially if your beneficiaries are young, so that you see them, throughout their life, right? So what happens if you do not pass on after 15 years? First of all, of course, I do not want you to pass on. You do not want to pass on. And the insurer actually doesn't want you to pass on, because at the end of the day, what they're insuring is your life, right? So the longer you live, the better. So if you do not pass on within the 15 years, what will happen is that on year 15, you will stop paying for the cover. So why are you stopping to pay for the cover in year 15? Because the time period for paying for the cover has lapsed. So after 15 years, you stop paying for the cover, but you're still going to be insured. You'll continue being insured. Why? Because it's called a whole life insurance cover. That means you're supposed to be insured your whole life. So even if you stop paying for the cover, let's say when you're 50 years, or even when you're 50 years, you're going to continue being insured because it's a whole life insurance cover. So even if you pass on at 100, 105, live at 150, it doesn't matter. You continue being under insurance. It's just that the insurance company give you an opportunity to pay for the cover for an X period of time, in this case 15 years. Okay. Now, if your beneficiaries are below the age of 18, you think of it as protection. You are protecting them from your premature death, because as you said, if you passed on, they would need a fallback plan. But if your beneficiaries are above the age of 18, you think of it as a liquid inheritance, because even you at your 36 years of age, if one of your parents left you 10 million shillings in cash as a liquid inheritance, wouldn't that change your life in one way or another?
It will.
Yeah, it would. So yeah, if they're below the age of 18, you think of it as protection. If your beneficiaries are above the age of 18, you think of it as a liquid inheritance. And even when your beneficiaries are below the age of 18 now, so for example, back to the example of a parent with a 3-year-old, if you buy it now, between now and the next 15 years, that is protection, because that is still a child. But after 15 years, that this child will be 18. At least now they're an adult. So when they're 18, you start thinking now of the same cover as a liquid inheritance, because ideally now after 18 they're not kids, they don't necessarily need protection. What they need is a liquid inheritance. Okay, now as you can see, those two what we've been talking about now, which is the primary reason why we buy a life insurance cover, that is for your beneficiaries. I always tell people that a life insurance cover, it is the greatest gift you'll ever buy to your beneficiaries, because as you can see, that has nothing to do with you. Also, something else I forgot to say, which is very, very important, is that the maturity of a life insurance cover is death. So in order for your beneficiaries to be paid, you must have passed on. Either you pass on prematurely or you pass on in old age. At whatever point someone will pass on, that is when the beneficiaries will have access to the money. So as you can see, that primary reason why we buy a whole life insurance cover.
Even after the 15 years?
Yes. After the 15 years, what happens is that after the 15 years, you stop paying for the cover. That amount of money, that amount in millions that had been promised to your kids, is still going to be held by insurance company, because the maturity of a life insurance cover is dead. So it is until you pass on that your beneficiaries are going to have access to that money.
Okay.
Clear?
What happens in the case where, sorry, I'm just very anxious as I come. What happens in the case where, let's say, your beneficiaries do die and you die? Who benefits from it?
Like all your beneficiaries die and you also die, but you have to die at the same time, no? In order for your question to apply. First of all, statistically, it's very difficult for all of you to die at the same time. But if let's say you have two beneficiaries in your cover and one of the beneficiaries die, what you do is that you remove them from your beneficiaries list, because now they're gone, they can't get the money. And if both of them pass on at the same time, if you have two beneficiaries, what you do is remove them and add other beneficiaries. When it comes to your beneficiary list, you can add, update, remove, edit at any point. Yeah, but then obviously if you passed on, and if your scenario was to happen, which is very rare, where you and your beneficiaries pass on at the same time, then in this case, because your beneficiaries are gone and you're gone, and now that means the life insurance cover has matured, what would happen is that now that insurance cover would have to go through the court system, because now the court has to appoint the next of kin who can get that amount of money, and it's usually based on who is your closest living relative. Yeah. Okay, so as I was saying, as you can see, what I've been describing as the primary reason why we get a life insurance cover has nothing to do with you. So because that money is primarily for your beneficiaries and they only get it when you pass on, so you will never have access to the money. So but that being said, as you can see, that's why I describe a life insurance cover as love expressed financially, because you have to remove yourself from the equation and think of your beneficiaries in order for you to get the cover. But as always, people ask me, okay, fine, I understand that, I would like to protect my beneficiaries, but how can I benefit from having the cover? So how you can benefit from having the cover is adding two things. adding these two benefits are optional, but they are equally important. So the first thing that you can add to your cover is a critical illness cover. So if God forbid you got diagnosed with a critical illness, and critical illnesses are many. There's stroke, cancers, kidney failure, major organ transplant, paraplegia, blindness. There's a very long list of critical illnesses. If God forbid you got diagnosed with a critical illness, you need money in order for you to treat that critical illness. And in our Kenyan society, what happens is that people wait, instead of getting a critical illness cover, they wait around. Of course, there's the aspect of there are people who cannot afford, but speaking for those people who can afford, you wait around, you get the critical illness, and then your solution to treating that critical illness is adding random people in a WhatsApp group. People you went to primary school with, and you're like, nichangieni, 5 million shillings, and to be honest, there are people in that group who will think that I also have my own problems, and you can't blame them because they also have their own problems, right? Especially in the Kenyan economy. So instead of waiting for such a situation, you add a critical illness cover to your whole life insurance cover. So that if God forbid you ever got diagnosed with a critical illness, now it's you to be paid X amount of millions so that you're able to seek treatment. So this critical illness benefit is customizable. So you can decide, I want 3 million benefit, 5 million benefit, 10 million, it's up to you. So if let's say you had added 5 million critical illness cover, if you got diagnosed with a critical illness, you'll be paid your 5 million and then you get to seek the treatment. And it's paid in cash as a lump sum to your bank account. So then you get to decide whether you want to seek treatment in Kenya or abroad. Like the insurer doesn't force you to seek the treatment in Kenya. The other thing that you can add to your cover is what we call accidental disability. In full, it's called accidental disability stroke death. So in this one, the way it works is that if God forbid you ever got involved in an accident, and accidents are many. You can be the driver who's driving the car, you can be a passenger, you can be a pedestrian. In Kenya, we have the boda menace. So if you get involved in an accident, there are two bad things that are likely to happen. The first bad thing is that you end up with a permanent disability. The second bad thing is you die from the accident. Either way, those are terrible things. But if you end up with a permanent disability, it is you who is going to be paid that benefit. So again, it's customizable. So let's say you had added a 5 million accidental disability coverage. So you would be given the 5 million accidental disability amount because a person who has disability, your life changes overnight. You need to change your lifestyle, you need to change where you live, maybe you need a nurse full time. So you get paid your 5 million and then you get to decide how you want to spend it in order to manage your new lifestyle. But if you die from the accident, now it is your beneficiaries who are going to be paid that accidental death money. So in the case of an accidental death, your beneficiaries are paid twice. The accidental death money and the whole life insurance money. Mm-hmm. So in a nutshell, that is why we buy a whole life insurance cover. Protect our beneficiaries if they are below the age of 18. Leave a liquid inheritance to our beneficiaries if they are above the age of 18. Protect ourselves from critical illness and protect ourselves from accidental permanent disability. So now you can ask me follow-up questions.
I'm not having any. I've had some where I think they call them the last expense or something, where you pay and then after 1 year, the money, it's gone and then you have to start again. But what I like about this is the fact that there's some level of continuity and sustainability. So it's not like you lose the money entirely, but at least your beneficiaries get to get it when you pass on.
Yeah, that's true.
Yeah. And what is the least amount of money that you can what are the amounts that you can insure?
First of all, life insurance is a factor of age. The younger someone is, the cheaper it is to insure them. And the older someone is, the more expensive it is to insure them. So by this I mean, so for example, an 18 to a 24-year-old, if you think of an 18 to a 24-year-old, it's possible for that person to get a life insurance cover with like 3,000 shillings. But somebody who's in their 30s, they can't get a good cover with 3,000 shillings. So instead of thinking of it as the minimum amount of money you can contribute towards the cover, I always like to think of it as what is my goal or how much money can I afford to put towards the cover. What is my goal is imagine someone is a parent, right? And they're thinking, if I passed on prematurely, what would happen to my 2 children? So in this case, as a parent, you ask yourself, if I passed on prematurely, how much money do I think is enough to take care of my children? So for example, I've had, I recently had a conversation with a single mom of 2 girls, and she told me, if I passed on prematurely today, I would like to leave each of my girls 50 million shillings, because I believe that 50 million is enough to cater for their education, even up to university, extracurricular activities, everything that these girls need in order for them to develop without having to beg or be a burden to anyone. So you see, now this parent is thinking of, this is my goal. I want a cover that leaves my girls 100 million. So then what I had to do is tell her, in order for you to leave 100 million to your girls, this, and based on your age, this is how much money you need to contribute towards the cover per month. So for her, it was about 75,000 shillings, and that is how much, that's the kind of coverage she got. So I want you to think of it either as goal oriented, how much would you like to leave your beneficiaries, and also how much critical illness coverage do you need for yourself, and how much accidental disability coverage do you need for yourself. So there's that one school of thought, goal oriented. The other school of thought is, what is my budget? Because you see, you can say, oh, I'd like to leave my beneficiaries 100 million, but hauna 75 but hauna 75,000, sindio? Yeah. So apart from that, you can also think of it as, I do not have 75,000 shillings. You can also think of it as, how much money can I afford per month? So then you say, my comfortable amount is 10,000, 15,000, 20,000. Because the other thing I always tell my clients is, make sure you buy a cover that you can afford, right? I think of it as, by buying a whole life insurance cover to protect your beneficiaries, and also having critical illness and accidental disability benefits, it means you're buying peace of mind, that you won't leave your beneficiary stranded, and peace of mind, if anything happened to you in terms of critical illness and accidental disability, you're covered. So make sure you do not buy this piece at a price that will rob you of your peace today. So you think of it as, how much can I afford? So for example, the way you said you can afford between 10 to 15,000, I would be able to tell you, for that amount of money, what kind of benefits can you get?
Okay.
Yeah.
Yeah, the other thing that I was thinking about, what company is the insurance with? What company?
So personally, okay. So personally, I use and recommend Prudential Life Assurance. Because they have the best life insurance coverage in Kenya, in terms of the benefits, in terms of the terms and conditions, in terms of accessibility, and most importantly, in terms of payout, right? Like, yes, they will pay you when you have a critical illness. They'll pay you, because that's the biggest concern people have about insurance. They'll pay you when you have a critical illness. They will pay you when you have accidental disability, and for sure they will pay your family when you passed on.
Okay.
So then now we can do the math. Right, so you're 36, you've already turned 36?
Yes.
Okay, so 36, female, non-smoker, and then we do a 15-year cover. So first of all, the best options when it comes to this cover is 10, 15, or 20 years. So somebody who is in their 30s, a good cover is the 15-year cover, because you're 36, which means you will finish paying for this cover when you're 51, right? And a 51-year-old person is still a productive member of society economically, so you'd still be able to pay for the cover. So I've chosen a 15-year cover, and then I will use 15,000 shillings as your monthly premium. Now, before I'm going to tell you the benefit for your beneficiaries before I add the critical illness and accidental disability. And then after that, I'll tell you the benefits after I've added the accidental and critical illness. Okay?
Okay.
So, all right. So with 15,000 shillings for a 15-year cover, before or without adding the critical illness and accidental disability, you get 24.7 million for your beneficiaries. What do you think of this figure?
It's okay. It's something.
It's something. It's something. Do you think it's sufficient?
That's a question of, it will never be. You can never get to a point where it's sufficient. But at least when I say something, like it's a good starting point.
Yeah, that's true. That's
And
true.
then the other question that's coming to my mind as we are talking, does it have to be like that? Like the how do you call it? The premiums have to be that same amount, or you can increase over time?
Yeah, you can change your cover usually at least within 2 years, right? Because remember, insurance is a factor of age. So a few years from now, you'll
Within 2
be.
years of when you start.
Yes, you can change the cover and say, oh, now I want to pay, 20,000, 25,000. But after the 2 years, it's not that you don't have a solution. There's a solution. After 2 years, you can take a second cover.
Okay.
Yes.
Okay.
So you're allowed to get as many covers as you can afford, or rather you can get as many covers as you want in order for you to achieve your goal. So let's say, like, back to that lady who wanted 100 million. So like right now you can take a cover like this one that leaves your beneficiaries 24 million, and later on you can take another one for 24 million, even until you achieve the goal that you wanted initially.
Okay.
Yeah.
I think that makes sense. And then in the case where you're not able to pay the premiums, what happens?
You have a 3 months grace period where if you're not able to pay month 1, 2, 3, 3 months or 90 days grace period. So even if somebody, let's say you lose your source of income and you're unable to pay within the 90 days, you're still going to be insured. Your cover only gets deactivated after 90 days of non-payment.
And what happens when it's deactivated?
When it's deactivated, it means that you're no longer insured, right? Because in order for the insurer to insure you, they need you to continue paying payments. But the beautiful thing about...
you get back your premiums, or it's gone?
No, when it comes to life insurance, anywhere, any provider, there's no getting back your premiums. Because think of it this way: that period of time when you are paying, they had insured you, right? If anything had happened to you during that time, they would have paid you. So there's no getting back your premiums. And also, to add more information, is that yes, after 90 days, you have the 90 days grace period, and after the 90 days, you have the 90 days grace period, and after the 90 days, you still be insured if you are able to pay within the 90 days. After the 90 days, it's going to be activated, which means you're not going to be insured. But the good thing about Prudential is that they say, because you see, life happens to people, right? Where you've lost your source of income or you've lost your job and you really can't go back to paying for this cover after 90 days. So even if they've deactivated for the cover, if you're able to get back on your feet within 2 years, right? If you get your source of income or you get a job within 2 years, you can always come back to them and they will reactivate your cover. All you have to do is pay the arrears that had accumulated, obviously, and they will activate your cover, which is a beautiful thing, because then that means you have not lost your premiums. Because it would be sad for, imagine somebody has paid premiums for like 5 years and then zikunywa maji hivyo. Wow, that would be sad.
I know.
Yeah, even me, that would really scare me. Yeah.
Yeah, because life happens. Anything can happen, and you can take whatever time. But if there is that, that in 2 years you can still come and get your insurance activated, then it's I think that's good news.
Yeah, it is. Yeah, it was 24.7 million without critical illness and accidental disability. So now I have added for you a 5 million critical illness cover and a 5 million accidental disability cover. Remember, as I said previously, that the critical illness and accidental disability covers are customizable. So I've just added for you 5 million as a starting point, or rather, because usually from my observation, most people who get critical illnesses, they're usually trying to raise at least 5 million. So I always say that if you're getting a critical illness cover, make sure it's at least 5 million. But of course, you are allowed to tell me, reduce that amount or increase that amount. So now the cover will be 5 million critical illness, 5 million accidental disability, and then the amount for your beneficiaries is 19.8 million.
And then what is the, how much on top of the 15,000 do you need to pay to cover for the accidental and critical illness?
No, I used the same 15,000 shillings to shop. Think of it this way: you have 15k. At first, I had used the 15k to shop for one benefit, which is whole life insurance, and that is why it was coming to 24.7. But now, because you need the critical illness and accidental disability, I used the same 15k to shop for another the other two benefits, and that is why the whole life reduced. So you don't necessarily need to add an amount of money.
So the whole life will be how much now?
The whole life will now be 19.8 million.
And then the critical illness is 5 million, and then the accidental 5 million.
Yes.
I think that's okay.
All right. Additional information before I need to give you before I ask you whether you want to take up this cover is, number one, in order for you to be insured, you will need to go through medical tests. Think of it as a general medical test, right, to make sure that you're in good health. So that's the first thing you need to, and then you'll go through the medical test, and then when you're found that you're of good health, then you will be insured, like your insurance cover will be activated. So that's the first thing you need to know. The other thing you need to know is that when it comes to the critical illness and accidental disability, you're covered between now up to your 65th birthday. 65.
Okay.
Yeah. So that means for you'll be covered. Is it 29 years? Yes. For the next 29 years, because you're 36. And then the other thing you need to know is that to cater for inflation, because right now when you get this cover and you think of it as, I've gotten my beneficiaries 19.8 million in benefits, in payout. Right now, it's a significant amount of money, right? But 10 years from now, due to the rising cost of living or inflation, the insurer needs to cater for that. So what happens is that the insurer gives a 2.5% bonus. So 2.5% of the 19.8 million. So 2.5% of 19.8 million is 495,000. So this means for every year that Dorcas is alive, remember it's not for 15 years, it is for every year that Dorcas is alive, even if she lives for the next 40 years. So for every year that Dorcas is alive, this cover will earn her an additional 495,000 per year in bonuses. So then that means if Dorcas lives for the next 15 years, we multiply the 495,000 times 15, so that is an additional 7.4 million. Means if Dorcas passed on 15 years from now, her beneficiaries would get the whole life insurance amount 19.8 and the 7.4 million in accumulated bonuses. So now that I've told you everything that you need to know, then I can ask, is this a cover that you'd take up?
Yeah, definitely. It's something that's a good plan.